the biggest mistake I believe most buyers make isn't in the closing process. It's the day after, it's 90 days after, it's 180 days after. First Savings Bank. We are headquartered in Jeffersonville, Indiana, which is just over the river from Louisville. We act as a fairly common community bank, or I'd say typical community bank within that market of Southern Indiana, Northern Kentucky, doing deposit services, real estate loans, construction, kind of the normal stuff you'd think of as a bank. But outside of that, we also have an SBA team, which I'm part of. We only do SBA 7A loans. We are national in scope. In fact, I think only one of us is actually in the headquarters. Everybody else is pretty well dispersed around the Midwest, Southeast, and up into New York. I'm in St. Louis, but do deals nationally. We have no kind of prohibited industries. Hotels are a little tough right now because we have a lot of them. But other than that, pretty wide open in terms of deal sizes, industries, et cetera. Everybody's going to tell you when they do these calls how different they are and how their money's a little different shade of green and their dollar's worth $1.10 instead of $1 even. We all do the same thing for the most part, but to Jay's comment, maybe a little bit different flair, a little different interpretation. One of the things we do a little bit more unique than I think some of our peers, while technically anybody can do this, very few people are comfortable with it and even less advertise it. We will do 100% financing for expansion loans. That would include existing businesses buying buildings, equipment, and even other businesses within their field. I'm doing one right now that is a business acquisition of a technology firm buying a competitor out. And it's actually more than 100% financing when you throw in the guarantee fee and working capital and some other items like that. So that one is a little bit different. Again, anybody can do it, but very few do. Where I believe, and this is a little bit self-serving, so take that with a grain of salt, but where I believe that an SBA lender, when you have an individual call with one about an opportunity, where I try to differentiate myself from the pack is not the closing. Everybody in my role is going to tell you how great they are at closing, how wonderful they are at it. They're the best closer. They'll probably even say, I closed X number of millions of dollars last year. Pretty much everybody in this space closes loans. Otherwise, we wouldn't be in it very long. But where the biggest mistake I believe most buyers make isn't in the closing process. It's the day after, it's 90 days after, it's 180 days after. Very few people in my role have any clue what happens the day after you close a loan. So when I gained a little bit of a unique experience at my previous employment where I was at for 10 years, that's where I was actually introduced to the To Go Abundance when I closed a loan from one of the individuals that's part of it. Most people, what happens afterwards is you go from working closely with someone in my role for months, upwards of years in some instances, till you find what you're looking for. Form this great relationship. You start, you're constantly talking about it. And then the day the closing comes around, we become a ghost. You don't see us ever again. You're flipped to a servicing person. And you're flipped to a closer, then a servicing person afterwards. Part of that's just the nature of the SBA. Since there are no covenants, there's no maturities. Even if we wanted to monitor credits, we can't really do anything as long as you're paying us. So they tend to be monetarily impactful. They take the sales staff out and they put a servicing person in it. I had a very unique experience at my last bank where I was a hybrid lender doing SBA and conventional loans. And we just housed it under kind of the same umbrella. Horribly inefficient for a bank, but was a great training for me because most people that are on your end of the call are going to ask a question at some point to their lender or lenders they're talking to of how many of these deals go bad? How many go into default? In a business acquisition, it's a fairly low number. If a bank at any point has more than probably at most 5% of their loans in default, they're gonna have some serious trouble as a bank. Most of them are kind of in the very low single digits. So, but the statistic you don't see is the number of businesses that struggle post-close. And struggle could mean anything from, I thought my cash flow was 2x, I'm barely at 1-to-1, I'm pissed off, pardon my French, to holy cow, I don't know how to make payroll on Friday. What I gained in having a portfolio I managed post-close was that I saw those struggles, and I would probably put that number at closer to 20 or 25% of opportunities. Struggle can mean a bunch of different things, but
Yeah.
I gained a little bit different appreciation for what happens afterwards, including, unfortunately, not deals I originated myself, but inherited. I had to go through 2 liquidation processes, including bankruptcies in both of those. So I'd probably tell you, if you're going to work with me, I'm a little less aggressive than the average 7A lender, not because of we can't get the deals done, but most people in my role will go to, not, am I doing this loan correctly? Is this the right structure? To, will my bank let me do this so I can get paid on it? And it's a terrible experience, but it really does change you and how you go about things to go through those processes. When someone's on the other side of the table crying, they're about to have their house taken, it tends to take a little bit off the table for you as someone who just, there's a person behind it that you can see that most people never have had to deal with. And not all of them are that extreme, but even just sleepless nights entrepreneurs have post-close because of some issue that, normally gets flushed out in credit. In almost every instance, when a deal does go sideways, it's because of something you knew going in. You maybe identified it in the credit process and you mitigated. A common one is customer concentration. A lot of people will be like, well, they've been they might be a 40% customer concentration, but they've been with the company for 10 years. They're long-term, they know people. It doesn't have to be a catastrophe on the other end, like a bankruptcy or them exiting, for you to still have a serious impact. The current owners can absorb that kind of concentration because they likely don't have much leverage on their balance sheet. We're going to put a ton of leverage on the balance sheet the day we close our loans. So while the SOP for the SBA doesn't mention that kind of stuff, I take it pretty seriously because I kind of take the approach that what can happen will happen. So if I'm doing something like a customer concentration, I'm going to assume the day after we close, that customer's gone. And I have to underwrite accordingly. I'm supposed to be, I don't want to say I'm supposed to be the negative one, but I'm supposed to be the conservative one in this. You're supposed to be the one telling me, no, this company is going to be great. And there's nothing wrong with this place. And everything they do is perfect that I'm buying. I'm supposed to challenge you on that. So kind of wrapping up the differentiator of it, it's not the getting the deal done that I feel is the hard part or the important part when you're deciding who to work with as a lender. I'm going to be someone who's going to challenge you and is going to say, did you think of this? Hey, what about this? And when you go, nah, I don't think so, I'm going to go, well, I do. So here's how I have to mitigate this, hoping that I never have to have a problem with it. But the last thing I want to do is get a call from you 6 months after we close and go, do you remember that problem we had? Yeah, it blew up in our face. Now what? My goal is to try to mitigate those issues early on in the process. The three, I think I've said this on one of the previous calls, but in most of the deals I've seen struggle over the years, it boils down to one of 3 things. One's going to be, is it an industry you should have had experience in that you don't? Not all industries require direct industry experience, but if it's one that does and you don't have it, that's either a problem or something you need to mitigate through the seller rolling some equity or an employment contract with key employees, something to that effect, until you do have the requisite experience to run that business. The second one is the hardest one, and that's capital expenditures, if it's relevant. I always have specific stories I can go over these opportunities.
Yeah, please.
CapEx is a big one. I did a deal back in 2014, I believe it was. And it was a company that did cell tower servicing, and it was like clockwork cash flow for years. Every time there's an upgrade to your phone, somebody climbs up in one of those towers and puts new equipment up in them. And this company was subcontracted out by the big, all the big providers at that point. And their guys would go up 200 feet in the air in these hoists. And I actually saw it. It was kind of a neat business, not one I could do without being terrified, but they like clockwork worked for years. So he goes in, buys this business, everything's great. 90 days-ish after they buy it, there's a merger talk, and I can't remember the carriers at that point, but all CapEx was shut down until that merger was either going to be finalized or didn't happen. So he sat on his hands for about 60 to 90 days with not much work to do right after he bought it. That merger actually didn't end up happening. And so they go, okay, we're back at it. Good. Well, the new upgrade comes out, all the new equipment shipped. He had a fleet of F-150s and a certain type of trailers. New equipment required F-250s and a wider trailer to take it so in addition to having no income for roughly 90 days, he then had to completely redo his entire capital expenditures overnight, just to function. So that was in 2015. That's the kind of story that never shows up on the statistics for the SBA because he never defaulted. He still we helped him out with deferrals. He went interest only for a while. His investors put a little more money in. He limped along for 5 years and finally exited that business. I believe it was in 2019 for what he owed. So that's the story of, you're not going to see that statistic, but I lived it with him for 5 years. Now, what could he have done differently in that scenario? There are some instances where that just happens. Nobody knew the equipment upgrades were going to be needed. Nobody knew that merger was going on. So I don't know that we could have said we would have prevented it, but, looking, and I obviously don't know the industry inside and out the way that he does, but if he looked back on it, usually you get some kind of a sense of, all right, did they really not know the new equipment upgrades coming out? We're going to need this entire new fleet of trailers and trucks. So stuff like that, that's the hardest one to know. But as any of you have looked at businesses before, specifically it's been through a brokerage, you're going to hear that every seller is basically an absentee owner. Every piece of equipment is in amazing condition. They bought hordes of it for tax reasons. And it does, it's barely used. And then you go do a site visit after you're under LOI and you go, the seller's working there 60 hours a week. All their equipment is humming all day long. You're going to have to replace some of that stuff. Over the course of 10 years, you're going to have to replace stuff while the SBA loan's outstanding, this equipment's going to need to be replaced. So most people, when they're underwriting, just add every bit of depreciation back as part of your SDE. That can be okay depending on the type of equipment, but no, you're going to have to appropriate some of that down the road. Even if it's not in year 1, it might be in year 6. And then the third thing I think that causes the most misses and the most immediate pain point is the working capital that's left in the business. Most sellers want to leave the cupboard dry and want you to pay the highest multiple that they possibly can get on every sale. And then they say to you, oh, we'll just borrow the working capital. That can be fine as long as the leverage that you're putting on supports it. So if you're buying something at a 4.5x multiple and having to put working capital on, your debt service isn't going to work. Most of the small business SBA-backed acquisition loans are done through asset sales. So you don't have a real template for this is what you have to do. If you're doing a stock sale, traditionally it's cash goes to the seller, everything else stays in place. In an asset sale, you can drive whatever you feel is relevant. Where that comes into play the most with working capital is if you have inventory. A lot of deals go to market where you're buying it for the EBITDA multiple, and then they want you to pay for the inventory on top of it. I don't think that's a very it doesn't work usually anyways because your leverage goes up. But similar to that, you're going to be buying most likely some level of mistake from the seller if you do that. By that, I mean they overbought inventory. They have inventory that is aged, and you're papering over that for them. None of this stuff is in the SOP other than the industry experience. That's a requirement. But otherwise, you're at the whim of the SBA lender telling you that if you didn't look at it. Most people, what they'll tell you on working capital is just say, go to the balance sheet, see what they always have, and you probably need that. That could be the correct number, but the likelihood is it's very different because you're going to be buying a cash-heavy and likely debt-free or at least debt-light business, and you're completely flipping the script to a debt-heavy, cash-free or cash-light business. For lack of a better way to say it, you're going to have to be a lot more efficient than the seller. Mm-hmm. The sellers of most businesses today, some of you who may own businesses today, have been able to be inefficient because we have had, depending on how they were impacted by COVID, they've had a run of about 14 years of good economic performance. Then they got PPP loans, either 1 or 2. Then they possibly have an ERC credit that's either been realized or at least is on the balance sheet to be realized. They get a bill on Monday, they pay it on Tuesday. They have a guy who owes them net 30 and he's at net 60. They go, it's Bob. He's going to pay me. I've known Bob for 20 years. So don't, in my opinion, again, it's your business. You do what you need to do. But I would not look at what the current owner is doing to figure out anything in terms of what you're going to need after you own it. The hard work on these acquisitions when it comes to is more important to me is that working capital number than even the multiple paid. If you overpaid by a quarter turn of EBITDA, you're going to kick yourself, but you'll go, it's over 10 years. You'll absorb that. If you miss your working capital by 10, 15%, you're going to feel it. And similarly, if you overpay by 10 or 15%, you're going to pay through the nose for it because it's very expensive to buy working capital over a 10-year term at, with the SBA guarantee fee at what's unfortunately right now a high interest rate. So anyway, Jay, your way of how I say I differentiate myself from the pack, I believe I'm a little more focused on what happens afterwards than just can I get the deal done. There are a lot of deals I've looked at and just said, I don't feel comfortable doing this. If you want to do it, I get it. I'll put you in touch with this lender I know who I think would do this. But having gone through some of these situations in the past and having a fairly close relationship with some of the people, professional relationship with some of the people who went through it, it does change you of how aggressive you want to be as a lender. It's not, I guess in my mind, it's not just the credit person's job to say no. It's my job to get everything settled before that person even sees it. So that's a little bit differentiation for you if you want to split hairs a little bit. Our money all looks exactly the same. It's 10-year terms. The rates are usually within a quarter or half point of each other, but those are the three areas I'm going to focus on that I think a lot of lenders in my space drop.
Yeah, that's powerful. Drew, you had a question?
Yeah, I do have a question. You hear me?
Yeah, go ahead.
First of all, Colin, thanks for the info. This is really good stuff. I had a discussion this week with some partners and some friends who we own businesses, they own businesses, all of that. And we were just talking about the risks that come with the violations of covenants. And my partners and I work really hard to make sure that we're not violating covenants. We get our PFS in on time and just try to be a good player all the way around. But we got our docs out, we got their docs out. Like we were comparing, a couple of different banks, and one's Huntington and one's Comerica and one was, I forget what the third one was. And when you look through these covenants, like even if it seems like you're violating a covenant for sneezing on a Tuesday. Yep. You know what I mean? Like almost anything. So it feels like,
especially if you didn't tell them you were going to sneeze on Monday.
Yeah, right. Exactly. Right. And so the thing is like, we're all three businesses. They're in good shape. We're making our payments every single, like there are stressors, but not at all like risk to the business or things like that. But, it would look like if it's black and white, like we're violating SBA covenants, but some of them are so in depth. I don't know how you could operate within them. It's like 100%. So what thoughts do you have on just like how to be a good player and all of that?
Well, you hit on a point that's mentioned a lot within SBA lending that is a little bit of a most of the time, but SBA lenders say it's all the time. So what a lot of SBA lenders will tell you is that you're not allowed to have covenants on an SBA 7A loan. The wording of that is poorly worded because what the real answer is that the SBA will not honor a guarantee if you put someone in default for violating a covenant. So backing up, Drew, I'll tell you how this process works. So what the SBA 7A loan does, it acts kind of like an insurance policy for the bank against a loss.
Yep.
So when if I do a $4 million loan and 3 years into it goes bad, and we liquidate collateral and force guarantees, go through the whole ugly process, we lose $1 million on that deal. We file a claim with the SBA called a 10 tab, and it is effectively, if we did everything right, they're supposed to cut us a check for 75% of our loss, or in that case, $750. If the scenario you just described, Drew, we put you in default and you failed as a business and we went to the SBA to claim our guarantee, the first thing they would do is say, did he pay you? Was he paying you before that default?
Yep.
The answer is yes. We're not allowed to put you into default and still get our guarantee honored. So my old bank used to have covenants, and they were quarterly cash flow covenants. And it was kind of a interesting dynamic every quarter when you had deals that were downgraded, to use a boring bank term for you. But you'd have to go through these meetings and they'd be like, what are you doing about it? And we just have to go, we can't do anything. If we put him in default, he's still paying us as agreed. We can't do anything. And now the key to that commentary is, notice when the SBA comes in at the very end. So if you have a deal that has heavy collateral, really strong personal guarantees, the bank can make the calculus to say, we're not going to need the SBA in this deal. We can put them in default because we want to, for whatever reason. Similar to another thing, I have a story. It's your comment with this was actually apt. I had a deal back in like 2013 that was a landscaping business in St. Louis, where I am. And they kind of called me in a panic. And I'd talked to the guy a few times over the years, but I was doing hybrid lending. So he was looking for a commercial loan against his landscaping business. He'd originally done an SBA loan with National City Bank. National City failed during the recession and was acquired by PNC. I won't bore you to death with how those acquisitions work, but you can basically segment these loans, and he was segmented in the bucket that was kind of like, we're going to watch this. And so what PNC ended up doing was selling a big book of loans to a private equity firm. And this, as any of you have been in finance before, know, a private equity firm's not paying dollar for dollar. You're paying 10, 15 cents on the dollar for that. So his loan at that point was originally $2 million, and it was real estate, equipment, all sorts of stuff glommed together. He owed about 1.3 on it, and he had a building worth $1 million. If you took just that loan out, that equity firm probably bought it, as part of a package, but percentage-wise, it was like $130,000 to $200,000. So right there, if you're that PE firm, you say, he owes me $1.3 million, but we only owe $200,000 against it, and we've got $1 million building. They immediately put him into default and said, you've got 30 days to cure or we're foreclosing. And his attorney fires off a letter, and more legalese than this, but said, you can't put him into default. It's an SBA loan. We've been paying as agreed. And they said in even more legalese terms, we don't need the SBA. Effectively, the SBA would never have been part of that. So it's the long answer for you, Drew, is it really depends on what the bank's thinking is there. Even on conventional credits, the point of a covenant at the small business level, it's different when you're talking about PE firms or family offices or large corporate, but the point of a covenant in a small business group at most banks is to say, let's monitor their performance. Let's catch something before it's a problem. Ideally, that's what that bank would be doing. But if you're in violation of a covenant, they technically could put you into default and say, go somewhere else. Now, the reason you did an SBA loan, most likely in the first place, is because conventional financing wasn't available to support what you were doing. So most of those instances, there's nowhere to go. So that bank would either have to just continue working with you, or if they were being really stubborn about it, would put forward something that says, you have to get out, and they hope they never have to enforce their guarantee. Normally, that I've not seen since 2008 and 2009, banks get real heavy-handed with small business loans. Back then, they had to clean up their balance sheets as much as possible. They had to create liquidity as much as possible. So they were trying to get rid of anybody who had any kind of, rough spot to them. Right now, it would be a pretty big risk for a bank to actually put you in default. Now, are you looking at term sheets, or are you looking at loan documents from them?
Mostly just the loan docs.
Okay. It's probably worth talking to your individual lender. I'm going to guess that he or she doesn't know, though, what the real answer to that is, because it's not a firm answer. Most banks don't have, I know at my previous bank with covenants, we did it as a discussion point. Hey, you missed your cash flow covenant. What happened? Tell me about it. Now we're going to put it in the file, and we'll look at it next quarter. If they have PGs on it, which they would if it's a small business loan, most likely, you tend to not be as heavy-handed as you would be if it was a private equity firm that can just walk away from it with no recourse. So individual banks are going to do that very differently, Drew. I just talked for like 4 minutes and gave you no answer whatsoever there.
No, it's good. It's good confirmation. I mean, it's what's been shocking to me, like kind of on even a secondary point, is like I have a partner. He's got a business. I've got a business. Same business. One's with Comerica, one's with Huntington.
Yeah.
And Comerica is in his building every 3 to 6 months. They come through with a clipboard. They ask the questions. Like, he's not allowed to go to the bathroom without permission.
Right.
But with Huntington, like, we will, with trying to be a good operator, like, we'll shoot them an email and say, hey, we're thinking about doing this, or we're going to sell this old equipment, get a new equipment, but we know that's tethered to the loan, blah, blah, blah. They're like, yeah, sure. Like, send it, and it's almost like they could care less. But my buddy with Comerica, like, it's just a whole different approach. And that was unanticipated by me, I guess.
Yeah. And you might even find within individual banks, there's a different flair for it in different regions. It kind of depends on their managers and their processes that they're going through. So, and I don't know the strengths of Comerica. I know Huntington pretty well. I don't see Comerica too much. Are these SBA loans or conventional?
Both are SBA, but one's 504 and one's 7A.
Is his the 504?
Yep.
So that is a traditional bank loan that he has. On a 504 loan, for those that don't know, traditionally that's done for either buildings or fixed equipment. You can't use it's not rolling stock or trucks. It's going to be CNC machines or overhead cranes within it. Think of it as something that never leaves the building. A 504 loan is an SBA product where you do an A and B structure. So use even math. It's $1 million purchase. 50% first lien is with the bank. 40% second lien is technically you close with the bank and then it's refinanced by what are called economic development councils or community development councils. They sell a bond. They sell a government-backed bond, refinance that loan. You're left with a long-term fixed rate. What Drew's referencing there, though, that first mortgage, if it's a building or first lien position, is just a conventional bank loan. Mm-hmm. So in that scenario, Drew, if they put covenants in the loan documents, they have to deal with those covenants, is probably the best way to say it. Whereas your SBA lender, Huntington, probably has very light covenants anyways, even if they're in there.
Yep.
But even if they do, they can't enforce them. So that's why your friend is seeing a pretty big difference. I'm guessing. I don't know all the ins and outs, obviously, but that is, I'm going to guess where you're seeing the big miss, is that he has a conventional bank loan in first mortgage, and he's in violation of some level of covenant that they put in there.
Yep, that's it.
Okay. Joel, you had a question of how much room is there to negotiate covenants. Depends on the bank, but everything's negotiable. And 7A loans is a little different because you have some language that's very boilerplate the government requires, but within a bank, you can get exceptions to every credit policy. So if you're getting a conventional loan, for instance, most small business loans are going to have a covenant of debt service coverage ratio. That's most of the time what a bank cares about. Where the nuance comes in is things like distributions. If you had where I had a deal go, technically have to get downgraded was because they got a PPP loan, ended up not really needing it. We're sitting on a mountain of cash. And so they took a big distribution one year. That distribution technically was in violation of their debt service coverage ratio. So even though this company had no issue whatsoever, they were killing it, we still had to downgrade it and send a notice of violation of covenant to them because we didn't recognize the PPP income as revenue. Kind of like a stupid nuance, but that's the kind of stuff you have to deal with in banking. So negotiation of covenants, it's really going to come down to what are they looking for? You're going to have a debt service coverage one, most likely, if you're doing a conventional deal. You can argue for things like distributions not being included. A lot of balance sheet covenants are usually going to be about your minimum net worth or your leverage. So I think you can fight on a lot of covenants. You can also shop around banks and see who doesn't really have those covenants in there. If it's a conventional loan, especially if it's below $1 million, A lot of banks don't do anything at that point because it's not monetarily worth it to them to monitor. But you can negotiate them, but you can also shop around to banks, just like you would for interest rate. Say, what are your covenants? Now, an SBA loan's a little different. You likely aren't going to have too many covenants. Really, it's just annual tax returns, annual PFS, possibly quarterly financials just to see how the company's doing. But it's not really all that enforceable, even if you don't send them in. We can't do too much about it.
On that real estate acquisition or the 100% financing, can you speak to that a little bit more?
That was my second thing I was going to talk about of how I am a little bit different. Yeah. No, but so every bank that does SBA 7A loans can do 100% expansion financing. And so what that means, if you have a business and you're buying something, a building, equipment, possibly even another business in your field, and there's a little more nuance to that, but the bank can finance 100% of that, not just the physical cost of the acquisition, but also closing expenses. All that can be rolled in. I gave Jay this example when I've talked to him in the past. I have a deal in Cleveland that's been languishing forever. I don't know if it's going to end up happening, if he's going to move forward, but I proposed on him with $1 million. It's $1.5 million building acquisition. He's a manufacturer. Buying a building for $1.5 million. There's $1 million of construction that's needed, probably higher now. $350,000 of equipment and a couple $100,000 of working capital. We're rolling all of that into one loan over 25 years with zero cash down. So that's an expansion situation where he is taking his building, taking his business up in expansion. We have a little bit lesser credit requirement on the cash flow there because we're leveraging to do it. But it's only like I think we're only needing 1.05 debt service for an expansion loan like that. So you can do that. It's only for existing businesses, so it wouldn't be for a business acquisition, but there's no real rule to how long you do it. So if you are buying a business and then you want to buy the building later, you can technically do that 6 months later and buy the building with 100% financing. You're going to pay an SBA 7A interest rate there, though, which is going to be less attractive. But I say this a lot, and nobody on my credit team's on this, so I can say it. I always say you don't buy an SBA loan, an SBA 7A loan, you rent it. You're not going to want to have a real estate loan for a 7A loan for 25 years. You have a higher floating rate interest rate. At some point, you're going to go, it's time to refinance this. Your typical point is going to be in either year 3 or year 4. The prepay on a 7A loan that has real estate attached to it is 5% year 1, 3% year 2, 1% year 3, and then it goes away. So if you're buying something today, if you're a business owner today and you're buying even your own building, and let's just say it's $2 million, your options are you have 3 options on that. One is a conventional loan. Any bank in your area will do it, most likely, or will want to do it. You're going to put down 20 or 25%. You're probably going to get a 5-year term and a 25-year amortization. You might pay a 0.5 to 1% origination fee. You'll have the covenants that we've been discussing in there, but it's going to be your lowest interest rate. I have no idea what that would be right now, but I'd put it somewhere in the ballpark of 5 years fixed at, say, 8%. Your second option is the 504, in which case you're going to put down 10%. You're going to have $1 million first and $800,000 second. The second is the SBA piece. That would carry a 10-year prepayment penalty. It declines by 10% a year. Your prepayment penalty is based on the interest rate at close. That rate right now is something in the ballpark of like 6.5 to 6.75 fixed for 25 years. So very attractive interest rate. Just have the hefty prepay, and you're going to pay a lot of closing costs to do it. So that benefit hits you. I always put it in, like, depending on the deal size, I put that about year 6 or 7 is when that starts to be, you're completely in the black on that deal. And then the 7A loan is going to have the highest interest rate, and it's going to, like, at that same number, it's going to have a decent guarantee fee to it, but you're going to have no cash down, and you're going to refinance it in 3 years. So whenever I look at something like Jay's talking about, I always kind of give all 3 options. I only do one, but I can put you in touch with people who do the other, the conventional and the 504. but it really is just a situational thing. The 7A works two ways where a benefit is. One, you have better uses for your money. Either you don't have it to put down, or you say, hey, I have that $500,000 personally, but I'd rather keep that in the market. My business can support this debt. Or the scenario I gave you, you're also rolling other stuff in it. That deal in Ohio I just mentioned, that $350,000 of equipment that he was buying would normally have a 5 or a 7 year amortization on it. We rolled it into a 25-year term. So as far as cash going out the door every month, he's actually in a better situation, even with the higher interest rate. It's high. It's painful. SBA rates are attractive right now, but in theory, it's going to come down. We'll see if rates really do come down like they say they're going to. But those are some unique things you can do within the 7A, and not every. I'd say most 7A lenders don't like to do 100% expansion financing.
And how about when you acquiring another business in the same industry? So does it have to be within the same geography? Does it have to be like absolutely the same NAICS code? Where are the nuances there?
Yeah, so geography would be relevant if the business has a geography kind of relevance to it. If you're a manufacturer that's buying another manufacturer, it's kind of tough to argue. You can watch both real closely if you're in, Pittsburgh and they're in Southern California. You can still do, even if you weren't doing 100%, you have to justify that. The one I'm doing right now is a technology business, though, and one's in California and one's randomly in St. Louis, where I am. And they're in the same field, and he can just absorb him. It's all virtual, so he can absorb that deal. Their NAICS code is close enough. It's got to be in this. I think the wording is it has to be in the same family. So if your code is 32765, I don't even know if I did the right numbers there, and you're 32745, you're still okay. The hard part ends up being a lot of companies file their NAICS codes wrong on their tax return because there's not really a wrong way to do it. But the SBA focuses a lot on it. So even people who do exactly the same things, sometimes they just have their NAICS code wrong, and you can't really do anything about it. But that was newer. They just defined that in the recent SOP this past fall. So a lot of banks are still digesting that, but it's well within the range of what you're supposed to be doing. You just have to kind of justify the how more than the can you.
Got it. So geography wise, it's all depends on supervision. Essentially, you have to be able to see the business, to touch the business. Okay.
Yeah, I mean it's and that again is used in regular acquisitions too, even if you're putting down the typical 10%. But within the guidelines of what they're saying, it's supposed to be within it uses a typical government term like normalized or something like that geography. But yeah, I mean, I think the only other one I looked at, it was about 2 hours away. You could probably justify that pretty easily. I think when you start talking about planes versus cars is probably the way to look at that.
Got it. That makes sense. You mentioned something earlier around acquisitions, stock acquisition versus asset acquisitions, and you mentioned that in the stock you only take your cash and you leave everything. So can you break that down a little bit more?
Oh yeah, I mean there's still no rule to it.
Okay.
What you see in most larger acquisitions, whether they're public companies, whether they're private equity, is a stock purchase, in which case the company seamlessly transfers. It's still the same tax return. It's typically what you see in those scenarios, though, is that the cash goes to the seller. The only time I see a lot of stock sales in the small business world is if they're in medical related and they need to keep their Medicare and Medicaid licensing in place. Or the new thing, they just allowed last year for companies to roll equity when they sell. So if you're buying a business and the seller wants to stay on, they can roll their equity. That has to be a stock sale. It has to maintain the same business. That's very, anybody's got their own opinions on whether that's good or bad to have somebody stay on. The benefit I saw to it, if you're buying something in the trades and you're not a licensed tradesperson in that field, you never used to be able to rely, or you weren't supposed to rely on the seller's license to operate post-close. Now you can. They can roll 5 or 10% equity, and if they're a master plumber, you can keep using their license in perpetuity. That was the only real benefit I saw to having sellers stay on the ownership table. But that's the only other time. As a buyer, you're likely not going to want to do a stock sale because you don't get amortization, and your tax benefits when you sell one day are going to be a lot worse. So almost all of these end up being asset sales. If you're doing a stock sale, you're negotiating that with the seller to drive the purchase price down a little bit because they have huge tax benefits on the other end.
Yeah. But in terms of financing, it doesn't matter as far as the bank doesn't care.
No.
Either way. Got it. Any questions, guys? Can you speak to the changes that happened in the SBA lately and what stuck and what didn't stick?
So one thing that still is gray, but I don't know if it's relevant for anybody on the phone call. If it is, very good for you. But they took out the personal resource requirement, meaning, for lack of a better way to say it, you couldn't be too rich and still have an SBA loan before. They didn't, as again, typical of government, they said you can't have too much money. And you go, okay, well, how much is too much? And it's like, well, too much. That was the answer, basically. So most banks tended to have a number they'd stick to, like 1.5 or 2 times the loan amount. So if you had $1 million loan, you couldn't have $2 million in liquidity. They took that out. Where that became a problem a lot of times was I have a very specific example I'm looking at now. The guy has $30 million of liquidity, but he also has a marketables. It's actually in like treasuries, so it's completely liquid and isn't going to lose value. He's got a $27 million debt against it of interest-only debt. So that guy technically, while he shows a very big liquidity amount, doesn't have a ton compared to what he's doing. That would have been ineligible before. And they took that provision out, so we're actually able to look at that deal and still kind of move forward with it. That change, they took that out. Technically, I think they were supposed to take it out 2 years ago, and they just got rid of it, the requirement, or they defined it last year. Rolling over equity, that was a big one. That was kind of a seismic shift. That was always a big no-no with the SBA, and they changed that. I think it was typical of what most of their changes usually are. They didn't mean it, what they're using it for. It was probably supposed to be because when you had companies where the owner owned 96%, and maybe his or her CEO or CFO owned 4%. Under the old rules, the CEO had to be gone in 12 months also. And so I think their mentality was, well, let's let those minority owners roll over. And immediately every person doing this goes, well, there's a loophole. I can do this now. So that was a pretty big change that's new. The down payments last year, the typical language used to be 10% down. Then it switched a few years ago to 10% is the total equity, but if you did a 5% seller note on full standby for the life of the SBA loan, that was considered equity. So the bank still lends 90%, but it's 5 from the buyer, 5 from the seller. No idea why, but last year they changed it again to that seller financing piece can be 2 years no payments, and then it has to be a full amortization. So you can't balloon that note. So that was a pretty big change last year. And then they also threw in there, again, no idea why, but they threw in that you can buy a business with 2.5% down, 7.5% seller financing, interest only, I believe for 2 years on that as well, and then also a full amortization. So you tend to have the ability now as buyers to get into businesses with very little cash down. I can tell you as a bank, most banks don't love this, obviously. They want equity in, unless you have it. So if you're somebody who says, well, I have the equivalent of 30% equity, but I'd rather hold on to my cash and have the seller finance that, you're likely to get a bank to bite on that. Saying I want to buy a business for $5 million when I have a total of $250,000 to my name and the rest is the seller, and my God, this thing better work or it's not going to be pretty. Those are a little tougher. I think there are banks that do it, but that's a pretty high leverage situation that I don't think I'd be terribly comfortable with, but to each his own.
That 2.5% version didn't have standby in it. I may have missed it.
It's interest only.
So it's just 11.5 interest only, and then
it amortizes.
It's interest only first 2 years, and then amortizes after that. Okay, got it.
And the company has to be able to, where these are tougher to do now than they were. This wasn't in the SOP at that time, but a couple years ago when SBA loan rates were kind of in the 5.5 to 6.5 range,
Yeah.
you could do a lot of this stuff and it would still cash flow. Now that you're seeing rates kind of trending to like 11%, you're not seeing these work that well anymore. Now, one thing I would tell you, I do a lot of that makes deals work is get pretty creative with the seller financing. If you want to be glass half full to what high interest rates allow you to do, you can actually compensate a seller for taking back a bigger note and probably still be cheaper than a 7A loan. You know, if a typical 7A loan is say 11% right now, when you add the guarantee fee in there, your kind of APR is going to be more like 12%. So if you have a seller that has any kind of tax acumen, because what most sellers you'll see when you're making an acquisition, they care about two things. First is, how much money am I selling this for? And two is, how much do I owe in taxes because of it? So you can play around with this a bit, and I'll make up numbers here, but say you're in a relatively high tax state and you buy a business for $4 million. $4 million probably means you're talking about a business that has $1 million-ish, give or take, cash flow. And if they've been like that for a while, that seller probably has an okay amount of personal liquidity themselves already. They've now flipped to less, I got to get every penny out of this, to more of how do I minimize my tax obligation. So right now, and this would be an accountant, not me, so take this with a grain of salt, but the way we've kind of played around with it is to say, okay, if you had a $4 million acquisition, if they took $1 million seller note back, so they're 3 at cash at close, $1 million seller note, pay them a 10% interest rate. The amortization, go out as long as you can, 25 years, let's say. You balloon it in year 3. So what that does is really helps you with this debt service coverage, because instead of the full loan at 10 years, you have a portion of it over 25. So you get this big tax or cash flow relief up front. Hopefully, interest rates would come down in the next couple of years so that when that balloon happens, you're going to be borrowing at cheaper interest rates. That structure made no sense to sellers 3 years ago because your SBA loan was only in, let's say, the 6.5% range, and they were getting 7 to 10 in the market. In their mind, they go, no, I want all the cash I can get at close. I'll pay the tax because I know my return is going to be better. Now you can offer them a 10% rate, and depending on what state they're in, over 3 years, you might cover their capital gain for them on that $1 million. So $300,000 over that time. You can, somebody who's financially savvy enough to understand that with their accountant might be more amenable to helping you finance this, especially, like I said, if you can do it under a term that has 25-year terms to it, that'll be huge for your cash flow. Those are the fun things you can do when you're negotiating these up front that can make you look different than the pack. Because if you just go in and say, I'm going to give you $4 million at close, you just did what everybody did.
Yeah.
If you do something creative, even if they don't end up doing it, at least it makes you stand out from the pack a little bit.
So I have this situation that's came up twice for me the last couple of months, which is a business for sale that has real estate, where the real estate is worth a lot of money now because the business could carry a certain amount of rent, but it can't carry the full note. Yeah. So how have you seen a situation like that resolve? Like how would you design a structure to acquire that business?
You're effectively saying the rent they're charging themselves isn't equivalent to what they're hoping to get out of their real estate.
Correct.
3.5 years of real estate's gone up a ton over time.
Correct.
Yeah. So it happens it happens a lot, actually. As a bank, and probably the better way to say it, when you get a business valuation, they're gonna change the rent to normalized rent.
Yeah.
So if they're only charging themselves $25K a year right now for rent, and they're supposed to be charging themselves $100 based on the market, they don't get the benefit of the juiced EBITDA for lower rent and the value of the building, if that makes sense.
Correct.
So you do have to adjust that as part of the process. You don't have to be the bad guy in that scenario. The bank can be. And even if the bank doesn't do it, the business valuation is going to. The easiest way to combat that is to not buy the building and say, I'll just keep paying you the same rent you're paying right now.
Yeah. So in the case that I'm thinking of right now, the guy wasn't charging much rent at all. And then when he put the sim together, he put a performer rent in there. He just said, okay, I'm going to charge 30 grand. This business still works at 30 grand, but I would prefer if you buy the building from me. Well, the building, the mortgage is going to be 60 grand, not So when we went to deeper in negotiation, he changed his tune and he said, well, you know what? I don't really want to rent. I want to sell the whole thing.
Yeah.
So
you have to have, and a lot of brokers are actually pretty good, at least, about adjusting this, whether it's always exact or not, but is getting the normalized rent.
Yeah.
Because it's going to flush out at some point. It's either not going to work in the cash flow. We actually have your example is pretty apt to something I'm looking at right now. They're in one of the Carolinas, and the building's gone up in value a ton, and their rent they've been paying doesn't work. So they said the same thing. They want to be done with the whole thing.
Yeah.
The building's twice as much as the business acquisition, but the rent doesn't work. So I'm like, put it out there. What you'll either buy the business for full price, but you're going to pay the same rent they pay, or you're going to buy the building with it, but your business acquisition is going to go down because you have to have normalized rent.
Right.
And it'd be, everything's negotiable and depends on what somebody else will do, but they're kind of, if you put that argument out there of, well, fine, then I won't buy the building, but you keep the rent the same. You're telling me that's what this business is worth.
Yeah.
But then they want to go, no, I want the real value of the building. You have to decrease the EBITDA or the SDE to reflect the real rent.
Yeah.
And it's pretty common. They're not, the easiest answer you can give somebody is play hey, I do it. I think you're right on, but I've got this bank who's being a total jerk and he makes me keep doing this stuff all the time. He's the one telling me I have to do this. I think what you're doing is exactly the right thing.
I said that to him, and he said, just go and find some investors and get me a $10 million check.
Right. Sure.
That's it.
Play you back to him.
Could you talk about investor equity? How do banks view that? Is there tripwires or percentages and or ways to structure that to make it as amenable as possible to the bank in their view?
Yeah, you'll get different answers from different banks on it, Jeremy. The answer is, as long as they're owners, it doesn't matter. If you can't borrow the money, that's always the key term there. You can have a gift equity from like a family member or something, or a close friend, or there can be investors. Investors are relevant. If you get above 20%, they have to guarantee. So you want to keep the pool of investors down there. What the investors have to do is fill out the 1919 form, which is kind of like a background of saying, I'm not in bankruptcy. I haven't defaulted on debt in the past. I'm not a drug cartel. That's just a background that they have to fill out. And then they have to prove they still had the money the same way any other buyer would. So you have to have 90 days of statements. I did a lot in the search fund space previously. Those almost, not all of them, but about half of them probably had, not just did they have investors, that's where all the cash came from. You might see 20% in some of those deals that were bigger, and the buyer behind it only put in a couple thousand, maybe $100,000, but he raised $2 or $3 million. That's fine. The keys to it, and again, this is a little bit of what Jay mentioned earlier, kind of the nuance bank to bank of how you have this language. What you're not supposed to do if you have investors is pay physical cash payments a preferred return until the 7A loan is paid off. You can accrue, but you're not supposed to physically write payments to them. You're supposed to limit distributions either to taxes or pro rata distributions based on ownership, because they consider that debt, not equity. If you're paying them a defined amount, even though they're owners, that's considered equity, or that's considered debt by the SBA. Now, not all banks look that closely at that, but it's something I would probably recommend if you're talking to investors to do. A lot of investors are less worried about the immediate return anyways, because there's going to be tax consequences for that. But some will. So you just have to make sure you say, hey, we'll take distributions every year of excess cash, but it's not going to be your normal 8 or 10% clip. It's going to be your ownership percentage. Or you can have them, but we're just going to accrue it on the balance sheet every year until the SBA loan's paid off.
Thanks.
Sure. I don't think there was any other major changes. There was a couple things in affiliation rules that are kind of very, very nuanced that they changed. The down payment, the rollover equity were kind of the big ones. Everybody asks me all the time, are they going to increase the loan, the $5 million? I've not heard any rumblings of that. So I think that's the cap still. This isn't something we do, but for those of you that are looking for larger deals, the biggest difficult piece to finance in acquisition lending is probably businesses right around $1.5 million-ish, $2 million of cash flow upwards to about $5 million. Once you get above $5 million of EBITDA, you start to be able to put traditional bank leverage on there without the SBA. That's typically private equity, family office, sometimes individuals, but those are done. My old bank did a ton of that stuff where you do like a 3-to-2 ratio of leverage versus mezzanine financing versus rollover. SBA caps out at 5. So if you have a 2 or 3 million EBITDA business and you want to get, $8 to $10 million out of it, that's a difficult finance piece because it's below the threshold to get conventional. It's too big for SBA. There are lenders who do what are called pari passu loans. I don't know if anybody's been familiar with that or not, but essentially make up a deal. It's a $10 million acquisition. It's $1 million cash, $1 million seller note. $5 million is done via the 7A. $3 million is done pari passu or side by side that loan. And that pari passu loan has relatively similar terms as the 7A. We don't do that. I'm actually shocked the SBA allows it, quite frankly, because it's sharing the collateral. I think, like I said earlier in the call, I think it was designed originally with real estate in mind. If you think of something like a daycare, where it might be the business is worth, say, $900,000, but the real estate's worth 5.7. Those were always difficult to finance. So I think their thought was, there's real estate involved. Just do as conventional loans side by side. When they don't define that it's just for real estate, everyone goes, you can do business acquisitions that way too. So if you do have a larger credit and you want some help on that or some guidance on that, I, again, don't do it myself, but I can introduce you to lenders who do. And I think that's a piece I'd probably want to end my comments on, Jay, is just because I can't do your loan for whatever variety of reasons doesn't mean I'm usually very rarely am I a no person. I'll say I can't do it, but here's somebody I know who can. Every SBA lender, to the earlier point, has the same SLP, but we all have different interpretations of it. And we also have different specialties that we kind of focus on. Some are heavy on acquisitions, some real estate only. Very few do kind of everything really, really well. Most of the stuff, but not everything. So if you have questions, even if it's something I can't do, I'll usually be able to help you find somebody who can.